European bath lounges.
Well, it's not recovered at all. In fact, the market pressure is accelerating now. The Bank Nifty is now down 1,130 points. The Nifty is below the 20, 50 and 100-day moving average. So a lot of levels are being scaled on the downside. But on to a special now. Like we've been telling you, CNBC-TV18 has compiled a list of the top 20 stocks to watch for this year. It's a carefully curated list of companies that warrant a closer look in 2023. Ekta is standing by the big wall to tell us what's on her radar this year. Ekta, over to you.
Thanks for that. Well, that's right. Today on my radar is a stock from the healthcare space. So why am I looking at Apollo Hospitals in 2023? On the possibility that the company could, after seeing delays in the past, finally monetize its new vertical, its omni-channel platform Apollo Health Co. It comprises of the back-end pharmacy and mainly its digital interface Apollo 24/7, which entails the online pharmacy, teleconsulting and diagnostics tests being booked online. The company has indicated they will be looking at fundraising by the end of FY23. A little more on Apollo Health Co. Q2 revenue was up 43% year-on-year to around 1,668 crores and a GMV which was up 38% Q-on-Q to around 294 crores. It has 20 million registered users, completed 50,000 medicine deliveries per day and 5,000 virtual consults and diagnostic sample collections. Apollo has spent around 300 crores in the first half on Apollo Health Co. and estimates are that they will shell out around 600 crores in FY24 to further support it. Guidance-wise, Apollo Health Co., as per the company, is performing ahead of what was planned. It is expected to be EBITDA neutral next year. For FY23, the company is expected to close with a GMV in FY23 and double it in FY24 to around 3,000 odd crores. So 1,500 crores going to around 3,000 crores. The arm is aiming to be the number 2 digital player in the country. The company is also looking for a maximum of 20% stake to be diluted and has indicated 200 million is the upper end of what they will be looking to raise. The company will aim to have valuations of at least around $2.5 billion. Options are between a strategic and financial advisor and will possibly look at only one investor. So what happens if they raise this money? It will help fuel growth. Remember, the e-pharma market itself is estimated to grow to around $2.7 billion this year versus around $360 million in 2019, with today's internet penetration in the country at over 50%. It will also help ease the cash drain on the core business. How? Eventually help reduce Apollo Hospital spend, which is tracking at around 150 to 160 crores per quarter, and help the margins recover for the consolidated entity. A few risks to take note of: the competitive intensity from other heavy-pocketed omni-channel plays such as Tata 1mg, Reliance Meds, and not getting the desired valuations, further delay in Apollo Health Co.'s fundraising plans. All this which could further result in a cash burn for the consolidated entity. In terms of brokers, most have a positive outlook on Apollo Hospitals. For example, Jefferies, Motilal, BNP Paribas, Kotak all have buys with respective target prices, as you can see on the screen. Their rationale is that they are positive on the outlook of healthcare services, but they do acknowledge investor concerns of a delay in fundraising of Apollo Health Co. and elevated competition in the entire healthcare space.
All right, Ekta, thanks a lot for that. In fact, as a standard disclaimer, this is not a stock recommendation. We reiterate, the CNBC-TV18 editorial team does not advise on trading or investing in the stock market. Any investor or viewer is advised to carry out necessary diligence on their own through a certified registered financial advisor for investment decisions. Having said that, market continues to weaken. In fact, now we're on the verge of breaking that 17,600 mark for the Nifty as well. Almost 300 points shaved off, and the Nifty Bank now down 1,200 points. We'll take a short break, come back, continue our focus on the markets, which are in a bit of a slippy slide right now.